So once we reduce the process of assessment in trading to a few indicators or oscillators, the decision making process starts becoming mechanical, and gradually the element of intuition is completely taken away. For example, the fact that I have used a MA cross on the Nifty 50 chart set on the hourly time frame is an indicative that every time there is a bullish crossover or a golden crossover, that is, the slower moving average cuts the faster moving average from below upwards. In such a case, the indication shifts from the previous death crossover, which was on the downside, to the upside bias. As we can see that when you are analyzing on the hourly chart, the biases can change very quickly. And a change in bias requires a certain versatility and adaptability from the trader. That is, till a few days ago, they could be hyper bearish on the market, and then all of a sudden, they are looking at the market from a different perspective or a new lens. So, we have understood so far, just to articulate the rules, which are fairly simple, that whenever we are using a MA cross, we will set a fast and a slow MA moving average. Alright, when the crossover results in the faster moving average being lesser in value than the slower moving average, we will assume the trend to be long. And the vice versa is true, that whenever the crossover, the vice versa is also true, that whenever the crossover results in the faster moving average being lower in value than the slower moving average, the trend assumed will be on the short side. In order to determine the strength of the trend, we are using an indicator in this called as the ADX, where the assumption is that if ADX greater than 25, then the trend is strong, and the trade will be through buying the CE or PE, which is buying the option. If the trend is less than 20, then the strength of the trend is weak, and therefore we will assume it to be a range, and here the plan will be to sell the CE or PE, that is, we will option write. If ADX is between the values 20 and 25, then there will be no trade, since it is unclear whether the security is trending or if the security is ranging. Once this is understood, the next step is to make the trade plan. The trade plan has many processes. The simplest process is what I have outlined here. Assuming the individual is using a single time frame to make the assessment and the trade, in such a case, the slower crossover, the slower moving average minus the ATR is going to force a change in bias or an exit. That is, if you have not taken a trade, then the bias will change or tend to change. But if you have taken the trade, you will necessarily exit. So let's look at what we have in front of us. We can see that there is a golden crossover, that the slower moving average, that the 20 period moving average is above the 50 moving average. We will also see that the ADX is at 29, which is above the 25 value. In other words, the decision going forward would be to buy call options. Further, we note that the ATR is approximately 85 points, and the 50 period moving average is approximately at 22,320. With this, we will have sufficient information to design a trade plan. We know that the slower moving average is approximately 22,325, from which we minus 85 to reach a value of 22,240 as an approximate value. And here I will mark with the red line. This red line indicates that at any point in time the trader initiates a sell side trade, a buy side trade, they have to consider exiting here. And now the question is, where should the trader initiate the buy side trade? And here it is my view that the trader should consider, if you are using a single time frame, should consider the slower and the faster moving averages in order to initiate the long side trade. If a trader uses the slower moving average, that is here, if entry on the slower moving average, which here means the 20 MA, so I will mark here as 20 MA, then we are trading with the hypothesis of a bullish strong trend. If entry happens on the, by slower here I mean by the shorter duration, shorter MA, happens if the entry happens on the longer MA, that is the 50 period moving average, then we will assume that the trader is trading a bullish weak trend. The only reason why we should be long on the market is because either the market is bullish strong or bullish weak. But if at any point in time the market gives up the trend and threatens to enter a range which we would have calculated by the MA 50 minus the ATR as potential loss of trend, the trader has to close the positions. Now the question is, what if there is a fake artificial touch till this value and the market fully recovers and then rallies up? Then my answer is, such is life. The intention of putting the stop loss is to determine the quantity that we are eventually going to trade. Without the stop loss, there is no information on the quantity. Further, the intention of the stop loss is to determine the strike price that we are going to trade. For example, here we can see the strike price is going to be 22,200 call. Without this information, we simply cannot take the trade. And every time we take a decision in the market, we have to come to terms that there is a potential that the decision will be proven wrong. But if the technique is correct, then repeating this activity over a long period of time is likely to generate positive results. That is, if generally for stocks which have a bullish crossover with ADX above 25, if you buy them on the support of the moving averages, generally you will do well or better than individuals who are just randomly entering and exiting the market. For any individual who makes the process of speculation a skill-based endeavor, they need extended durations in the market in order to leverage that skill, because in the extreme short term, a highly lucky trader will beat a highly skilled trader. It is only in the long term that these averages pan out. The intention of this video is not to give a trade call on buying 22,200 CE. The intention of the video is simply to use the price action as it unfolds in order to articulate the opinion that a professional trader may form based on extremely simple indicators, so that by repeating this process yourself, you will begin to see gradual improvements in your own trading plan. With that in mind, I wish you the best for the remainder of the trading week.